The settlement conference lasted 4 hours and 20 minutes, and when it ended, Terrence walked out of the building on Peachtree Street with the expression of a man who had got everything he came for. He had by every visible measure won. He had the investment portfolio, a joint fidelity account we had built over 9 years that held $480,000 at the time of valuation. He had the lake house in Cherokee County that we had purchased together in 2017 for $320,000, and that had appreciated considerably in the years since. He had the primary residence in Sandy Springs, awarded to him on the basis of an argument his attorney had constructed across 11 months of litigation with a thoroughness I genuinely respected, even as I watched it succeed. He had 60% of the defined equity in the marriage, awarded by a judge who had reviewed the asset disclosures presented to her and concluded, reasonably and correctly on the basis of what she had been shown, that the marital estate had been divided equitably. What she had been shown was incomplete, not by my hand, by his. By the time Terrence walked out of that building wearing the expression of a man who had won, the Internal Revenue Service had been in possession of a referral from a certified public accountant in Atlanta for 6 weeks. The referral described a pattern of unreported income, undervalued asset disclosures, and structured financial arrangements that the accountant, whose name is Constance Osei-Dankwa, and whose firm Osei-Dankwa and Associates on Peachtree Industrial Boulevard I had retained in 2018 and whose judgment I trusted completely, had identified and documented with the precision that only someone who has spent 22 years doing forensic accounting work brings to the task of reading another person's financial life. The IRS does not move quickly, that is the nature of the institution. But it moves with a completeness that no private legal proceeding can replicate, because it has access to instruments, summons authority, third-party financial records, the full history of every filed return and every filing obligation that no divorce attorney can obtain in discovery. When the tax investigator arrived at Terrence's new home in Roswell 4 months after the settlement, she arrived with a case file that had been built quietly and methodically while he was celebrating. My name is Zara Afori-Mensah. I am 45 years old. I grew up in Tucker, Georgia, the youngest of 2 children. My father was a senior accountant at a manufacturing company in Norcross for 28 years. My mother owned and operated a small alterations and custom tailoring business from a dedicated workspace in our home for the entirety of my childhood, managing every invoice, every client payment, and every business expense with a discipline that I understand now from the perspective of someone who spent 17 years in tax law and financial compliance, was genuinely sophisticated. She used a columnar pad from Office Depot, the kind with the 12 green ruled columns, to record every transaction the business generated, every client payment received, every spool of thread, every bolt of fabric, every machine maintenance expense paid out, sales tax collected and remitted quarterly to the Georgia Department of Revenue, federal self-employment tax calculated and paid on the estimated payment schedule every April, June, September, and January. She never confused business money with household money. She never ran a personal errand through the business account. She said, "Zara, the government's money and my money are not the same money. You learn that early or you learn it later at a cost you will not enjoy paying." I learned it early. I graduated from Georgia State University in 2001 with a degree in accounting. I sat for the CPA examination in 2003 and passed all 4 sections. I joined a mid-sized Atlanta accounting firm specializing in tax compliance and litigation support, and spent 6 years there, advancing from staff accountant to senior associate and eventually to a manager role overseeing a client portfolio of closely held businesses and high-net-worth individuals. In 2009 I left to complete a law degree at Georgia State University College of Law with a concentration in tax law, graduating in 2012. I was admitted to the Georgia Bar in the fall of 2012. I want to be precise about what that combination of credentials, the CPA license, the law degree, the 6 years of tax compliance work, actually produced. It produced a person who understood from both technical and legal perspectives exactly how wealth is documented, how it is reported to the government, how the gaps between documentation and reporting are created, and how those gaps are found. I had spent 11 years of my professional life either helping clients comply with their reporting obligations, or in litigation support engagements, helping attorneys understand what the financial records actually showed when a dispute required it. I understood how money hides, not in the abstract, specifically technically, in the exact instruments and structures and reporting positions that people use when they are moving wealth in ways they would prefer not to disclose. This knowledge was not something I advertised in the context of my marriage, it was simply what I did professionally. I joined a boutique tax advisory firm in Atlanta in 2013, Hargrove, Boateng & Mensah, a 7-attorney firm on West Peachtree Street specializing in tax controversy, business tax planning, and compliance for closely held companies, and I became a partner in 2017. My practice consisted of advising businesses and individuals on tax compliance, representing clients before the IRS in examination and appeals proceedings, and providing litigation support to family law attorneys who needed a forensic accounting perspective on financial disclosures in divorce proceedings. That last category of work, litigation support for divorce cases, was, by an irony I did not anticipate when I built my practice, exactly the work I would eventually need to deploy in the context of my own marriage. I met Terence Quarty in 2010 at a professional conference in downtown Atlanta. He was 36 years old, ran a commercial landscaping company he had built over 8 years from a single truck and a trailer, and spoke about his business with the specific pride of someone who had created something real from a starting point of almost nothing. By 2010, Quarty Commercial Landscaping had 15 full-time employees, contracts with several office park management companies across the Atlanta metro, and annual revenue that he described without being asked the precise figure as comfortable. He was self-made in the particular way that requires actual discipline rather than the performance of it, and I found that quality, the real version, not the advertised version, genuinely compelling. We dated for 3 years. I knew the contours of his business throughout that period. I knew the company name, the employee count, the general nature of the revenue. I did not know the financial detail of the company's operations because the financial detail of a privately held business is not a standard element of 3 years of dating, and I did not ask for it. What I will say is that nothing I observed across those 3 years, his personal spending habits, his apparent financial position, the consistency between what he described and what I could observe, triggered the professional instincts that 11 years in tax compliance had sharpened in me. He presented as a person whose financial life matched his stated financial position. That alignment, as I would eventually understand, was itself a form of craft. We married in June of 2013. The first years of the marriage were what they appeared to be in every way that mattered for daily life. We had a shared account at Chase Bank for household expenses, funded by regular contributions from each of us, managed without friction. We had a joint Fidelity investment account that we funded monthly with automatic transfers, a practice I had initiated in the first year of the marriage because the compounding mathematics of consistent contributions over time is not something a tax attorney and CPA needs to be persuaded about. We had the Sandy Springs house purchased in 2014, mortgaged through Regions Bank. We had what looked from the outside and from the inside like a financially orderly and professionally productive marriage between two people building something together. What I did not have for the first 4 years was any professional reason to examine what I was looking at. That changed in 2017. It changed not because of a dramatic discovery or a confrontation. It changed the way that financial anomalies always change the way a trained observer sees them, gradually through the accumulation of details that do not add up, until the day they add up to something specific. The first detail was a conversation at a dinner party in the fall of 2017. A contractor who had worked with Quarty Commercial Landscaping for several years mentioned, in the way that people mention things they do not realize are informative, that Terence had switched the company's primary banking relationship from Regions Bank to a community bank in Cherokee County earlier that year. I noted it without reacting. There was nothing inherently wrong with changing banks. What I noted was that Terence had not mentioned it, and that we had been married for 4 years, and that the financial detail of his business operations had been, throughout our marriage, something he summarized rather than disclosed. The summary had always been, things are going well, the details had always remained his. The second detail was the lake house acquisition in 2017. Terence proposed purchasing a property in Cherokee County, a lake house on Lake Allatoona that he had identified through a real estate agent, and we purchased it jointly for $320,000. His contribution to the down payment was $60,000 in cash wired from a personal account at the Cherokee County Community Bank, the same institution mentioned at the dinner party that I had not previously known existed. I asked about the account. He said it was a business account he used for local contractor relationships, that it simplified certain payment arrangements. I said, I didn't know you had a personal account at that bank. He said, it's more of a business account. I said, okay. I noted the exchange in the way I note exchanges that require more information to evaluate, quietly, completely, without conclusion. The third detail arrived in the spring of 2018. I was preparing our joint personal tax return, a task I had handled myself throughout the marriage because the alternative, paying someone else to do work I was professionally trained to do, had always seemed unnecessary, and I was cross-referencing Terence's Schedule K1 from Quarty Commercial Landscaping against the prior year's K1 and the 2 years before that. A Schedule K1 is the document through which a pass-through entity, an S corporation, a partnership, an LLC taxed as a partnership, reports each owner's share of the company's income, deductions, and credits to the IRS. For an S corporation like Quarty Commercial Landscaping, the K1 tells the owner and the IRS exactly what income the owner received from the company in a given year, and that income must be reported on the owner's personal return. The 2017 K1 showed a 23% decrease in Terence's reported income from the company compared to 2016, despite the fact that everything he had described about the business, the number of contracts, the employee count, the equipment additions, was consistent with growth rather than contraction. A 23% income decrease in the context of an apparently growing company is not impossible. It requires an explanation. I did not ask for the explanation. I made a note of the discrepancy and I continued preparing the return. The fourth detail 3 months later was a conversation I had not expected to have. I was reviewing a client matter at the office, a small landscaping company, coincidentally, whose owner had come to us with an IRS examination notice, and I was reading the revenue trend analysis our staff accountant had prepared. The revenue patterns of a well-run landscaping company in the Atlanta metro, I understood from that file, followed a predictable seasonal curve. Peak in spring and summer, reduced in winter, with an overall trend line shaped by contract renewals and client retention. Quarterly commercial landscaping's K1 income had been trending in a direction inconsistent with that curve for 3 consecutive years, decreasing annually while the business's observable indicators pointed in the opposite direction. I sat in my office for a long time after I closed that client file. I was not thinking about my marriage. I was doing what I do professionally, which is to follow a financial pattern to its logical conclusion. The logical conclusion of 3 years of declining K1 income in a growing business, combined with a previously undisclosed bank account, combined with a $60,000 cash down payment that had appeared from that account without prior notice, was not one that I was willing to state as a finding based on those facts alone, but it was one that I was trained to know how to test. I called Constance Oseidenko the following Monday. Constance had been a colleague of mine for 11 years and was the most precise forensic accountant I knew. I described what I had observed. She was quiet for a moment. Then she said, "Send me the last 4 years of K1s and the personal returns. Don't say anything to him, don't change anything, just send me the documents." I said, "I'll have them to you by Wednesday." I also called Miriam Asant Botang, the family law attorney I had retained quietly in June of 2018, the month I had called Constance. Miriam had been recommended to me by 2 colleagues as the most technically capable attorney in Atlanta for high asset dissolution matters with financial complexity. I described the situation. She listened without interrupting. Then she said, "I want to understand what you know and what you suspect, and I want to know the difference between those 2 categories." I told her exactly what I knew and exactly what I suspected. She said, "Good, the difference between those 2 categories is the whole case." The following 7 months were the most professionally demanding of my career, not because the work itself was extraordinary, forensic accounting analysis, IRS compliance research, documentation review, but because I was doing that work in a context of personal proximity that required complete operational separation between what I was discovering and how I was living. I was still coming home to the Sandy Springs house. I was still managing the shared Chase account. I was still updating the joint Fidelity portfolio. I maintained every domestic and financial obligation exactly as I had always maintained it, without variation, without signal. What I was doing in my professional hours was something he had no access to, could not observe, and did not know to look for. Constance completed her preliminary analysis in September of 2018. She presented her findings to Miriam and me in a conference room at Miriam's office on a Thursday afternoon, with the particular economy of language that forensic accountants use when the findings are serious and the evidence is solid. She had identified 3 categories of concern. The first category was income suppression. Quarterly Commercial Landscaping was an S corporation, and the company's income reported on Terrence's Schedule K1 for the years 2015 through 2017 was inconsistent with the company's observable revenue indicators. Employee count and payroll expense reported on the company's W-3 filing with the Social Security Administration, equipment depreciation schedules reported on the business return, and the commercial insurance premiums reported on the business returns deduction schedule. Each of those indicators, payroll, depreciation, insurance, scales with revenue. When they scale upward while reported on our income scales downward, the divergence requires an explanation. Constance had found no legitimate explanation for the divergence in the documents available to her. The most straightforward explanation, that income was being received by the business and not reported through the K1, was, she said carefully, consistent with the available data. The second category was the Cherokee County Community Bank account. Constance had traced the $60,000 wire transfer from that account to the lake house purchase and had cross-referenced the account's apparent opening date, which she had inferred from the wire transfer documentation, with Terrence's reported income for the prior year. The account had been opened in early 2017. The funds in it at the time of the wire transfer were inconsistent in size with the income Terrence had reported on his 2016 personal return. Constance said, "The account exists. The source of the funds in it is not explained by any return he has filed. That is the relevant fact." The third category involved structured cash transactions. In reviewing the business bank records available to her, limited to what she could reconstruct from the documents I had access to, Constance had identified a pattern of cash transactions in the business's operating account at Regions Bank that suggested, without conclusively establishing, the practice of structuring. The deliberate breaking of cash deposits into amounts below $10,000 to avoid the automatic currency transaction report that banks are federally required to file for single cash transactions at or above that threshold. Structuring is a federal offense under 31 U.S.C. 5324, regardless of whether the underlying funds are from legitimate sources. The pattern Constance identified was not conclusive on the available evidence. It was sufficiently specific, she said, to warrant referral to someone with the statutory authority to obtain the complete records. Miriam said, "How confident are you in these findings?" Constance said, "I am confident in the documentation I have. I am confident that the documentation I have is a fraction of what the IRS can obtain. I am confident that what the IRS will find when it obtains the complete records will be significantly more than what I can reconstruct from these documents." Miriam said, "Then we filed the referral." Constance said, "I'll prepare it this week." The Form 3949A, the IRS Information Referral, the form through which any person can report suspected tax law violations to the Internal Revenue Service, was filed with the IRS's Cincinnati Processing Center by Constance's firm in October of 2018. It described the 3 categories of concern, cited the specific tax code provisions potentially implicated, and attached the documentary analysis Constance had prepared. It was filed as a professional referral from a certified public accountant, which carries a different weight in IRS triage than an anonymous complaint, and which obligates the IRS's referral processing function to evaluate the submission against its formal criteria for opening an examination. I told Miriam I wanted to separate from Terence in November of 2018. I had taken 2 months after the referral was filed to be certain that the decision I was making was complete, and that I was making it for the reasons that were actually true rather than the reasons that were easiest to name. The marriage had been deteriorating in the quiet, factual way that marriages deteriorate when one person's knowledge of the other has been fundamentally revised and cannot be revised back. I was not angry exactly, I was clear. I had sat with the clarity for 2 months and it had not changed. I told him in the kitchen on a Sunday evening. I said what I had to say plainly. He was quiet for a moment. Then he said, with the confidence of a man who had spent years believing his financial position was opaque to the people around him, "I want to make sure we handle the business assets correctly." He used the plural business assets in a way that was intended to imply shared ownership of things I had no legal interest in. I said, "Your attorney can speak to Miriam about the legal framework for that." He said, "Miriam Asant Boateng." I said, "Yes." He said nothing for a moment. The name had registered. He said, "Okay." He left the house that evening. The divorce proceeding lasted 11 months. His attorneys constructed a comprehensive asset disclosure that presented QWERTY Commercial Landscaping as a business with modest profitability, consistent with the K1 history Terence had reported to the IRS, and a value they assessed through their own business valuation firm at $240,000. They valued the lake house on the basis of the purchase price rather than current appraised value. They presented the joint fidelity account and the Sandy Springs house equity as the primary marital assets available for division. The asset disclosure was internally consistent and professionally assembled. It was also, as Constance's analysis had established and as the IRS was in the process of confirming through instruments that discovery in a state divorce proceeding could not replicate, materially incomplete. Miriam's approach across the 11 months was deliberate and precise. She did not accuse, she did not allege. She produced interrogatories and requests for production that were technically comprehensive, requesting every business bank account statement, every corporate tax return, every payroll record, every vendor payment record, every cash transaction record from every account associated with QWERTY Commercial Landscaping from the date of the marriage to the present. Terence's attorneys objected to the scope of several requests. Miriam litigated each objection. Some she won, some she did not, and the records produced in response to the requests she won showed a business whose financial picture, even in the redacted and selected version his attorneys produced, contained anomalies consistent with Constance's preliminary analysis. She also retained her own business valuation expert, Franklin Acer Valuations, a mid-market firm in Atlanta with a specific track record in valuing service businesses in industries with significant cash transaction exposure. Franklin Acer's valuation methodology differed from the opposing experts in one material respect. It applied a revenue reconstruction approach, using the company's payroll expense, equipment depreciation, insurance premiums, and subcontractor payment records as proxy indicators for actual revenue, rather than accepting the reported K1 income as the revenue baseline. The resulting valuation, $490,000, more than double the opposing expert's figure, was submitted in the proceeding with a methodology section that explained, in terms accessible to a judge without a forensic accounting background, exactly why the reported income figures were an unreliable revenue indicator for this specific company in this specific industry. The judge reviewed both valuations. She did not adopt either figure wholesale. She found in her written ruling that the record did not support the complete reliability of the income figures reported in the business's K1 history, and that the asset disclosure presented by Terence's attorneys did not represent the totality of the marital estate's actual value. She ordered a more thorough forensic accounting review of the business records. That review had not been completed by the time the parties reached the settlement conference. At the settlement conference, Terence's attorneys made a calculation. The forensic review was incomplete. The IRS referral, which they did not know had been filed, had not yet produced a visible outcome. The judge's skepticism about the asset disclosure had been expressed but had not yet been quantified into a revised valuation. They calculated that the uncertainty of continued litigation was greater than the cost of a settlement that gave Terence the most visible and liquid assets in the marital estate. They pushed for the investment portfolio, the lake house, the primary residence. They conceded on certain items of lower value. They calculated that what they were leaving on the table was manageable. What they did not know was that the IRS examination of Quarty Commercial Landscaping, opened 6 months after Constance's referral, had progressed to the stage where the examining agent had issued summonses to 3 banks: Regions Bank, the Cherokee County Community Bank, and a third institution identified through the examination process, for the complete transaction records of every account associated with the business and with Terence personally going back 7 years. The summons authority of the IRS is not bounded by the scope of a state civil discovery dispute. When the IRS summons bank records, it receives every transaction, every account, every wire, every cash deposit, every structured transaction, the complete and unredacted financial history of every account connected to the examined entity. The examination had been proceeding quietly at the pace of a federal agency with statutory authority, while 11 months of state court proceedings had operated on a different timeline entirely. Miriam knew the examination had been opened. She had confirmed it through Constance, who had received the standard IRS acknowledgement that a referral had been received and was under review. She did not know its current status at the time of the settlement conference because the IRS does not provide status updates to the referring party. What she knew was that it had been opened and had not been closed, which meant it was active, which meant the outcome of the settlement conference was not the end of the story for Terence's financial position. She advised me to accept the settlement as offered. She said, "Let him take the visible assets. The lake house will likely be subject to a federal tax lien within 18 months. The business valuation for marital purposes is separate from whatever the IRS determines about the business's actual tax liability. Our position in the marital estate is protected by the documented record of the joint accounts and the joint property. Take what is correctly yours from the marital estate, which is equitable, and let the federal process proceed on its own timeline," I said, "and the rest." She said, "The rest will resolve itself through a process that has nothing to do with you and everything to do with what he reported to the government for 7 years. I accepted the settlement. I received the Joint Fidelity Investment Portfolio. Its full value, not a divided share, awarded on the basis of documented contribution records showing that the majority of the funded contributions had come from my distributions, the equity in a vehicle titled in my name, and a cash settlement reflecting my contribution to the Sandy Springs house down payment and the years of mortgage payments traceable to my personal accounts. The lake house went to him. The primary residence went to him. The savings account went to him. 4 months after the settlement, the IRS revenue agent assigned to the examination of Quarty Commercial Landscaping arrived at Terence's home in Roswell with a formal notification of the examination's scope and a request for an interview. The examination had expanded in the months since opening from an income verification inquiry to a civil fraud investigation. The distinction matters. A civil fraud investigation carries a penalty structure that includes a 75% fraud penalty on any underpayment attributable to fraudulent conduct, in addition to the full tax owed and standard interest. For 7 years of material income suppression in a business generating the revenue Constance had estimated, the cumulative liability, tax, fraud penalties, and interest was not a figure easily absorbed by the visible assets Terence had walked away from the settlement conference believing he had won. The federal tax lien, a public document recorded in the Superior Court of Fulton County, accessible to any person who searches the lien records, was filed against Terence Quarty and Quarty Commercial Landscaping 14 months after the settlement. It was for an amount I will not state specifically, but which exceeded substantially the combined value of the lake house and the Sandy Springs house at their appraised values. A federal tax lien attaches to all property of the taxpayer, real and personal, and takes priority over nearly every subsequent encumbrance. The Cherokee County Community Bank account, when the IRS obtained its full records, showed a history that resolved the question Constance had identified as the relevant fact. The source of the funds was not explained by any return Terence had filed because the funds had never been reported on any return Terence had filed. I did not learn the details of what the examination found through any official channel. I learned them the way that most people learn the details of a former spouse's legal difficulties, through the public record and through the natural movement of information in a professional community where many people know many people. I have not discussed those details with anyone directly connected to Terence or his legal representation, and I do not intend to. His situation is his own now, as it was always his own, and what the federal process produces for him is the consequence of decisions he made across 7 years that had nothing to do with me and everything to do with his own choices. The Fidelity investment portfolio I received in the settlement has continued to grow. I purchased a home in Brookhaven in my name alone, financed by a Regions Bank mortgage underwritten on my personal credit and my documented income, closed 6 months after the settlement. The firm Hargrove, Boateng and Mensah has continued to grow. My practice is intact. 6 months after the settlement, Constance Oseidenkwa came to my home in Brookhaven for dinner. After we ate, she said something I have returned to many times since. She said, I want you to understand something about what we did. We did not trap him. We documented what was real and we sent it to the institution that had the authority to verify it. Everything that happened after that was the record doing exactly what records do. I said, I know. She said, people misunderstand forensic accounting. They think it is about finding what someone is hiding. It is not. It is about reading what is actually there. What is actually there either matches the reported story or it does not. If it does not, the examination will find the gap. Our job was only to know where to look. I said, that is exactly what my mother taught me. She asked, what did your mother do? I said, alterations. She kept a columnar pad from Office Depot and she knew the difference between the government's money and her money before she knew much else about running a business. Constance was quiet for a moment. Then she said, your mother and I would have gotten along. 3 months after that dinner, my mother came to the Brookhaven house for a weekend. She brought the same thing she always brings, food and the columnar pad, which she still uses and has no intention of replacing with anything digital. After dinner on the Saturday evening, she sat at my kitchen table and updated her business records for the month. Her alterations business has been operating for 31 years. It has never once failed to remit its sales tax on time to the Georgia Department of Revenue. It has never once missed an estimated tax payment. It has been audited once in 2004 and the audit closed without adjustment because every record the auditor requested was in the columnar pad, dated, categorized and traceable to a bank statement. She closed the pad when she was done and looked at me. She said, you knew what you were looking at. I said, you taught me what to look at. She said, I taught you that money leaves a record whether you write it down or not. The question is who writes it down first. I said, I know. She said, good. She finished her coffee and she drove herself home to Tucker. Here is what is true and what I want to say carefully because this story can be misread in ways I want to correct before they form. I did not engineer an outcome. I observed a pattern that my professional training equipped me to read. I engaged a forensic accountant to evaluate what I had observed, and I sent the evaluation to the institution that has the statutory authority to investigate it. The IRS does not act on referrals as a favor to the referring party. It acts on referrals when the evidence supports an examination and the examination produces findings. What happened to Terrence after the settlement was not something I caused. It was something the record caused, and the record predated my involvement with it by 7 years. I want to say that clearly because the lesson here is not, know your spouse's financial secrets so you can use them. That is not the lesson. The lesson is the one my mother stated at a kitchen counter in Tucker when I was young enough to write it down and not yet old enough to fully understand it. The government's money and your money are not the same money. Know the difference. Report correctly. Because the record is always being written, whether you are writing it or someone else is, and the record will eventually be read by someone who has the authority and the instruments to understand what it says. The second thing I want to say is practical and addressed directly to anyone who is building something and managing their own financial affairs. A certified public accountant is not a luxury for people who own businesses, however small. My mother needed one in 1992 when she opened her business, and she found one, a woman at a small firm in Chambly who charged her $250 a year for the first 3 years, and kept her in compliance with both her sales tax obligation and her self-employment tax obligation from the first month of operation. A CPA who specializes in small business tax is not expensive relative to the cost of getting it wrong. The Georgia Department of Revenue and the Internal Revenue Service both have examination programs specifically designed to identify small business tax compliance failures, and both institutions use exactly the indicators Constance used: payroll expense, insurance premiums, depreciation, to identify businesses whose reported income does not match their observable economic activity. Compliance is not paperwork. Compliance is the record of what actually happened. A CPA helps you make that record accurate. Constance Oseidenkwa's firm, Oseidenkwa & Associates, is on Peachtree Industrial Boulevard in Atlanta and has been doing this work for 22 years. There are firms like hers in every major city. Retain one. The third thing is about the Form 3949 specifically, because I have received more questions about this from colleagues than about any other aspect of what I have described, and the answers are important. The IRS information referral is a public form downloadable from IRS.gov that any person can complete and submit to report suspected tax violations. A referral filed by a professional, a CPA, an attorney, a financial institution carries more weight in the IRS's triage process than an anonymous personal complaint, because the professional is making representations within the scope of their professional obligations, and the IRS's referral analysts know that. But any person can file a referral. You do not need professional credentials, you do not need an attorney. What you need is specific documentable information about the nature of the suspected violation and the identity of the taxpayer. Vague accusations are not useful. Specific patterns with specific evidence, the kind Constance assembled from 4 years of K1s and a wire transfer and an anomalous bank account, are exactly what the referral process is designed to receive. If you have specific documented concerns about financial reporting in your household or your business, the form is available and the process exists. Use it correctly. The fourth thing is the one my mother gave me, and it underlies everything else. Money leaves a record whether you write it down or not. The question is who writes it down first. If you write it down first, if your records are accurate, current, and complete, if your reporting matches your documentation, if the gap between what you have and what you report is zero, then the record, when it is eventually read, will say exactly what it should say. If someone else writes it down first, if the bank records and the payroll filings and the insurance premiums and the depreciation schedules tell a story that your reported income does not support, then the record will say that too. And the institution with the authority to read it has been building that record quietly on its own timeline with instruments that no private proceeding can replicate. For as long as the discrepancy has existed, Terence thought he had won the divorce. He had gotten the house and the cars and the savings account. He had negotiated for 4 hours and 20 minutes and walked out of a building on Peachtree Street with the expression of a man who had gotten everything he came for. What he had not considered, because he had not known to consider it, was that the record of 7 years of financial decisions had been accumulating in a federal institution's file since the day Constance filed the referral, and that the record did not need the divorce proceeding to resolve itself. It needed only time and an examining agent with a summons and the complete transaction history of 3 banks. The tax investigator arrived 4 months after the settlement. She had everything she needed before she knocked. She had the record.